Okay, so in this video, I'm going to talk about non-qualified deferred compensation. And um, this is an interesting application that life insurance does come into play with, but it's a little bit more unusual, at least to my way of thinking. So let's kind of start with talking about sort of more qualified deferred compensation plans. So for a qualified deferred compensation plan, so think a traditional 401k plan, things like that. That's considered to be a qualified deferred compensation plan, and it has to meet all kinds of specific criteria. So in terms of who it's available to, it has to be available generally to broad groups of individuals, non-discriminatory in terms of, relative to ranking within the company, things like that. Basically everybody has to have access to it, all those kinds of things. So for those kinds of plans, they have to meet certain types of things. However, sometimes for executives and so forth, it makes sense to have some additional agreements that are not under those qualified plans. And so, and as a little side note, I just have to sort of comment on this for a moment. The legal terminology associated with a 401k plan is, or at least I would argue from a marketing standpoint, terrible marketing, because it's called a deferred compensation plan, which sounds awful. It sounds like you're not getting paid, which really what's happening is you are getting paid. It's just some of your money is going into a 401k account and hopefully being invested in things that you chose and helping you grow your money and retire well, all of which is good. But calling it a deferred compensation plan, really from a marketing standpoint, from my perspective, just really sounds kind of awful. But in any case, so little random freebie there. So if I have a non-qualified deferred compensation, we can have some plans that aren't fitting all of those specified criteria. It's not a 401k. It's sort of outside that whole scenario. And one of the things that companies may do is essentially defer executive compensation. And so they may say, they've given the executive a compensation package, but a certain proportion of it is deferred until later. And so we're looking at something like that, for instance. One possible approach to that would be salary continuation. So after the executive has perhaps retired, they can continue to receive a salary, or maybe even if the executive passes away, maybe the salary is paid out to perhaps the surviving spouse for a length of time or something like that. And basically the idea is, we may have some features and things like that in play here to kind of attract an executive to come and work for the company. Now, if we have some of these kinds of plans, then these plans can be in sort of one of three conditions as it relates to funding. One would be unfunded. So that basically just means the company has made promises to perhaps continue the salary for a length of time, but they don't have any actual money sort of dedicated and set aside specifically for that. It's just the company has made a promise, and the company is saying that they're going to do that. And informally funded would be a situation in which the company has sort of internally earmarked certain assets specifically for that obligation, but it hasn't created a legal obligation for that, for those assets to be used, but they're sort of internally earmarked for that use. And so that would be more of an informally funded, where there's money sort of set aside, but it's maybe not legally specifically allocated for that. And then the final scenario for funding would be if this obligation is actually funded. And in this case, if it's actually funded, where let's say the company sets aside specific assets and legally sets them aside for that particular employee, then in that case, the money is there. And this is actually going to become a tax obligation to the employee, because basically money has been or assets have been transferred to the benefit of the employee. And so that's going to create a tax obligation, at least to the extent that those benefits have been vested. So to the extent that they really are vested for the employee and they really belong to the employee, then in that case, then basically this is now a tax obligation to the employee. So you could have unfunded, where the company just basically saying, hey, we're going to do this. They haven't actually allocated anything, but they say they're going to do it maybe out of the general funds or whatever operating budget. They're going to use money from the operating budget to fund this, whatever. Informally funded, where maybe they sort of informally set some assets aside, where internally, like, we're going to try to use this to pay for this obligation. And then you get to the actual funded, where they actually like legally set stuff aside. And to the extent that's vested, then that's a tax obligation to the employee. Now, in order if you think about this, then really as it relates to kind of the employee, how that's treated from a tax standpoint depends a lot on a few key factors. And that's the main factors are substantial risk of forfeiture, constructive receipt, and economic benefits. Let me talk about each of those. Substantial risk of forfeiture. So if I go back to that unfunded case where basically the company hasn't set anything aside specifically, they haven't allocated anything specifically, they just say, here's what we're going to do. Well, then there is substantial risk of forfeiture for those benefits. So specifically, if the company goes bankrupt or whatever, then they may not actually pay that. So if there is a substantial risk of forfeiture for that non-qualified deferred compensation arrangement, then it's not typically going to count as taxable, because in that scenario, it's quite possible that the employee may not ever receive that money. So if there's substantial risk of forfeiture, then that's generally going to mean it's not going to trigger taxes. By the time I get down to the actual funded, where there are specific assets that are legally set aside and everything else, well, if it's funded and everything else, then the substantial risk of forfeiture should go away at that point, because there's an actual asset specifically earmarked for this and set aside for this legally. And so at that point, even if the company goes bankrupt, those assets are set aside for this. Then there's the tax concept of constructive receipt, which basically is looking at, in short, does the employee have sort of, have they constructively received it, in the sense that if you are the employee and you can make changes or allocations to it, decisions, things like that, you've essentially taken some degree of control of it, then that's the idea. We're going to trigger more of that constructive receipt, and this is probably going to mean that you're going to have taxes that you're going to have to pay on that. Or if it's a situation in which basically with however this has been funded, basically you're receiving economic benefit from that, well, then this is going to be a taxable kind of event as well. So there are a couple different criteria that come into play in terms of whether or not this is going to be taxable or not. Now, interestingly, if I look at some of these non-qualified deferred compensation, where the company is making pledges to pay going forward, this is where life insurance comes back around. Oftentimes, these kind of arrangements are funded with either life insurance, some form of annuity, or mutual funds, etc. So basically, one of those things that a company could do, for instance, is if they have entered into a deferred compensation arrangement in which they're promising to pay out a certain amount of money to the executive over the next 20 years or something. What they could conceivably do is the company could perhaps purchase a life insurance policy that when the executive passes away, that life insurance policy pays the company a bunch of money, which helps them recoup the costs of whatever that deferred compensation was. Now, that's kind of one sort of application of how you can use sort of life insurance for this. The company could also purchase an annuity, which is paying in money, which could then be used to pay the deferred executive compensation. And so if that money is, if that annuity is specifically legally allocated to it, then that would be a funded. But they could buy an annuity and not specifically attach it to that. They could just sort of informally be using it for that, but not actually legally attach it to that particular deferred compensation plan. And also the company could just flat out, invest in mutual funds and use that to kind of pay for it. But again, it would come back to, was that, specifically earmarked, or is it just sort of informally earmarked for that or not? And because of that connection of the company may have certain things in place that are being used for it in some way, it's brings up an interesting issue, and that is if there's a deferred compensation agreement in place, then it should not reference a life insurance policy that is being used for cost recovery. So it should not, that agreement should not specifically reference a life insurance policy being used for cost recovery. Because if you do that, then kind of what you said is we just kind of created this legal agreement where there's a life insurance policy over here that's going to be used to pay for this, or at least for cost recovery anyway, after the fact. And so that could create a situation where that policy sort of, or that deferred compensation is sort of deemed to be funded, and then it becomes a tax obligation to the employee, and so on and so forth. So companies have to be a little bit careful of how they do this if they are trying to be cautious about what kind of tax implications this would have and so forth. Of course, if they don't fund it officially and legally, then there's at a very real level more risk to the employee. So there are trade-offs to those things. Okay, hopefully this gives you a little bit of a brief overview about how some of these non-qualified deferred compensation kind of arrangements could kind of work a little bit, and kind of how life insurance could play a role in some of them. Hopefully it helps. Thank you for watching, and have a great day.